This is what you absolutely must take away from principles of accounting. Even if you don't remember anything else that we talked about, if you understand and can effectively communicate the concepts that we talk about in this presentation, then you have successfully taken away the basic accounting principles that you will need to be a successful business person. And importantly, at the moment, this will also allow you to be successful on the final exam. In making this presentation, I referenced very heavily from a book that I think is very good at giving the basic overview of principles of accounting and just really avoiding all of the minutia that may not be as important and just giving you the information that is the most fundamental and most important for a business person to understand who obviously is not an accountant. So if you ever feel like you need a brush up on your accounting skills in the future, I would recommend this book. It's less than 100 pages as the title there explains, and it's very simple read and helps to explain in simple layman's terms the most fundamental principles of accounting that you really should know as a business person. So the very first thing that we need to talk about, and the most fundamental concept in accounting, is the basic accounting equation. That is that first bullet point there, assets equals liabilities plus owner's equity. That's how it's listed. You'll see in the next couple slides when we talk about the balance sheet and other financial statements that the basic accounting equation is in the same breakdown or format as the balance sheet. And that's why it's listed in this manner, because knowing that assets have to always equal, it's not just a sometimes thing, it always equals liabilities plus owner's equity. Now, in understanding what that actually means, if you skip down to the next bullet point, that is more of a logical way of understanding what this means. So if you're thinking about this as the owner of a company, assets are everything that has value that you could basically turn into cash. Liabilities are everything that you will have to pay for in the future that you haven't paid yet. So a debt that you owe, basically. So as the owner of a company, if you had to close down shop and liquidate the company, you change all of your valuable things to cash, you pay off all of your liabilities, everything that you owe, and anything that's left over you get to keep. So that's what owner's equity means. When you make that basic subtraction equation, everything I have that's valuable minus everything that I owe, and what does that give me? That's the basic accounting equation. So that should make it should make good sense to anyone who thinks about it that way. Now the balance sheet is just a more specific, detailed version of the basic accounting equation, where instead of just saying assets as a group, we have that broken down into several categories of assets. Instead of saying liabilities as a group, we have that broken down into several categories of liabilities. And owner's equity, if there's more than one type of owner's equity or component of owner's equity, that's where you'll see that broken down. Often these are formatted in terms of current and long-term. On the asset side, that just means what's more, on the current part, what's more easily turned into cash. On the long-term part, what is more difficult to turn into cash. On the liability side, current means anything that you will have to pay within the next year or the next business cycle, which is usually a year. And on the long-term side, it's anything more than a year. So it's pretty basic concepts there. But you'll see on all balance sheets, like you see in this example here, there will be a specific date. So you'll often hear a balance sheet described as a snapshot at one particular point in time of a company's financial position. So as of, in this example, December 31st, 2015, this is the financial position of the company, broken down into current and long-term assets, current and long-term liabilities, and the categories of owner's equity being retained earnings and common stock. The income statement shows, instead of a financial position at one point in time, it shows a company's financial performance over a period of time. And again, this period is usually a year. You'll see as components of the income statement that a company's gross profit equals its revenues minus its cost of goods sold. This is also sometimes called gross margin. A company's operating income is equal to its gross profit or gross margin minus operating expenses. These are expenses that have to do with the core operation of the business. A company's net income is equal to all of its revenues and gains minus all of its expenses and losses. You see two examples here of an income statement. One is a little bit more detailed. You'll see that both of them total down to net income. Also common between both of them is that you have revenues at the top and you subtract out expenses below that and they total to net income. On the left we have a little bit more detail where we have operating expenses separated out from general and other expenses. So if we were interested in finding operating income, it's very easy to find that when operating expenses are specifically singled out there. On the right side, it would be slightly more difficult, but you'll see examples of income statements that are less detailed, as the example on the right side shows, in companies that are typically smaller. The most important components of an income statement are knowing that revenues minus expenses equals net income. Net income is a component that is used in a whole lot of financial analysis, so it's a very important item. The statement of retained earnings is a very small or brief financial statement. It has really only one purpose, which, as you might expect, is to detail the changes in a company's retained earnings over a certain time period. Again, this is usually over a 1-year period. Retained earnings encompasses the sum of all of a company's undistributed profits over the entire lifetime or existence of the company. When we say undistributed, we basically just mean that we want to distinguish between profits that have been pushed out to the owners or the shareholders of the company. We want to distinguish those from profits that are still sitting within the corporate coffers or within the company. They can still either be spent to grow the business or pushed out and distributed to the owners. So this is a basic example of a statement of retained earnings, and actually you see that that's two separate statements, one for 1 year and one for the next. And it just shows beginning balance, net income, which generally would increase retained earnings. Net loss could also be included there if there was a net loss for the year. Dividends paid to shareholders, or that could be blank if no dividends were paid. And you see that the retained earnings ending balance from 2013 in this example is obviously, and should be, the beginning balance in the next year's statement of retained earnings. So it's kind of just a reconciliation of what the beginning to ending balances in the retained earnings account look like and how you got from point A to point B. The next financial statement that you need to understand is the statement of cash flows, and it's divided into these three parts: cash from operating activities, cash from investing activities, and cash from financing activities. For all three of these categories, the cash may be an inflow, where it's coming into the company, increasing the cash account balance in the company, or an outflow, where it's going out of the company. You're spending cash, or I should say you're expending cash. Now, some non-accountants wrongly believe that the statement of cash flows is kind of just another way to show the same information that's on the income statement. And it's true that some of the information on both statements is the same, but each statement has information that the other lacks, and the purposes of both statements are different. Now, technically, cash flow from operating activities includes any cash flows not specifically defined as investing or financing activities. The general idea, however, is to reflect most of the cash transactions that would be included in determining net income. So most of the cash transactions that you would see encompassed on the income statement. Common items that are categorized as cash flow from operating activities include receipts from the sale of goods or services, payments made to suppliers, payments made to employees, interest payments made to lenders, interest or dividends received from investments, and tax payments. Cash flow from investing activities includes cash spent on or received from the sale of investments in financial securities, stocks, bonds, etc., as well as cash spent on or received from the sale of capital assets. For example, assets expected to last longer than 1 year. Typical items in this category include purchase or sale of property, plant, or equipment, and purchase or sale of stocks or bonds. Cash flow from financing activities includes cash inflows and outflows relating to transactions with the company's owners and creditors. Common items in this category include cash received from investors when new shares of stock are issued, dividends paid to shareholders, cash received from taking out a loan, and cash paid to pay back the principal on a loan. As we have talked about previously in this slide, payments of interest are classified under the operating activities. And this example of a statement of cash flows shows those breakdowns, those categories, shows that depending on the category and the time and the instance, the net cash could be either provided by or used in each of these activities. And then we see the overall ending cash balance at the bottom. And it's showing here nothing in the beginning cash balance, but if there was a beginning cash balance, that would be netted with the line above that, the net increase or decrease in cash, and that would get us to our ending cash balance. So you see that these financial statements have interplay with each other. This would reconcile with your cash account in your balance sheet. So whatever the beginning cash balance is would be the ending cash balance from the previous time period on the balance sheet, and your ending cash balance in the statement of cash flows should equal your cash account on your balance sheet of the same date. Next, we're looking at financial ratios, and these were included in pretty much all of your chapters, one or two of them at the end of each chapter. They're broken into several categories, and we have the equations for each of these ratios written out to the right here so they're easy to reference. Liquidity ratios show how easily a company will be able to meet its short-term financial obligations. The two most frequently used liquidity ratios are current ratio and quick ratio, which again you see the formulas for those listed on the slide. Profitability ratios seek to analyze how profitable a company is in relation to its size. Return on assets and return on equity are the most important profitability ratios. Financial leverage ratios express to what extent a company is using debt instead of shareholder investment to finance its operations. The more leveraged a company is, the higher return on equity it will be able to provide its shareholders. However, increasing debt financing can dramatically increase the risk that a business is undergoing or undertaking. Asset turnover ratios seek to show how efficiently a company uses its assets. Inventory turnover and receivables turnover are the most important turnover ratios. GAAP is a concept that we started talking about from day one in Principles of Accounting. It stands for Generally Accepted Accounting Principles, and it's the name for a framework of accounting rules used in preparing financial statements. GAAP is created by the Financial Accounting Standards Board, which we typically would use the acronym FASB. The goal of GAAP is to make it so that potential investors can compare financial statements of various companies or similar or financial statements of one company over various time periods in order to determine which one or ones they want to invest in, without having to worry that one company appears more profitable on paper simply because it's using a different set of accounting rules. But who is required to follow GAAP? Well, all publicly traded companies, for one, are required by the Securities and Exchange Commission, or SEC, to follow GAAP procedures when preparing their financial statements. In addition, because of GAAP's prevalence in the field of accounting and the trust that many people put in GAAP accounting, many companies follow GAAP even when they're not bound by statute or law and required to do so. Governmental entities are even required to follow GAAP. However, there is a different set of GAAP guidelines created by a different regulatory body for governmental organizations. Since governmental organizations are organizations with a different purpose, typically have a different hierarchy, different financing setup, it makes sense that their financial statements are quite different and their GAAP standards are quite different than those of publicly traded companies. The terms debit and credit are terms that are synonymous with accounting, but often are also terms that strike fear in the hearts of people trying to understand what formal accounting rules mean. Without knowing it, most people in their everyday lives, at least before exposure to an accounting class, use a system of accounting known as single entry accounting when they record transactions relating to their checking or savings accounts. For each transaction, one entry is made. It's either an increase or a decrease in the balance of cash in the account. Likely the single most important aspect of GAAP is the use of double entry accounting and the accompanying system of debits and credits. With double entry accounting, each transaction results in two entries being made. These two entries collectively make up what is known as a journal entry. This is actually fairly intuitive when you think back to the accounting equation, assets equals liabilities plus owner's equity. If each transaction resulted in only one entry, the equation would no longer balance. That's why, with each transaction, entries will be recorded to two accounts. Debits and credits are simply the terms used for the two halves of each transaction. That is, each of these two entry transactions involves a debit and a credit. Now, if you've been using a bank account for any period of time, you likely have an idea that debit means decrease while credit means increase. That is, however, not exactly true. A debit or credit to an account may increase it or decrease it, depending on what type of account it is. A debit entry will increase an asset account, and it will decrease a liability or owner's equity account. A credit entry will decrease an asset account, and it will increase a liability or owner's equity account. From the perspective of your bank, your checking account is a liability. That is, it's money that they owe to you. Because it's a liability, your bank credits the account to increase the balance and debits the account to decrease the balance. An easy way to keep track of everything is to think of debit as meaning left and credit as meaning right. In other words, debits increase accounts on the left side of the accounting equation, and credits increase accounts on the right side. Also, this helps you to remember that the debit half of a journal entry is on the left, while the credit half is indented to the right. And when looking at a T chart or a T account, the left side shows debits and the right side shows credits. For the most part, when making a journal entry to a revenue account, we use a credit, and when making an entry to an expense account, we use a debit. This makes sense when we consider that revenues increase owner's equity, and thus, like owner's equity, should be increased with a credit, and then expenses decrease owner's equity, and therefore, unlike owner's equity, should be increased with a debit. The general ledger is the place where all of a company's journal entries get recorded. Of course, hardly anybody uses an actual paper document for a general ledger anymore, even though that's how things used to be done. Instead, nowadays, journal entries are entered into the company's accounting software. This could be a high-end customized program that's very expensive, or a more affordable program like QuickBooks, or maybe even just an accumulation of Excel spreadsheets. The general ledger is a company's most important financial document. Because it is from the general ledger and the information stored therein that a company's financial statements are created. In many situations, it can be useful to look at all the activity that has occurred in a single account over a given time period. The tool most frequently used to provide this one account view of activity is known as the T account or T chart, where debits are shown on the left side and credits on the right side. A trial balance is simply a list indicating the balances of every single general ledger account at a given point in time. The trial balance is typically prepared at the end of a period prior to preparing the financial statements. The purpose of the trial balance is to check that debits in total are equal to the total amount of credits. If debits do not equal credits, you know that there have been erroneous journal entries that have been recorded. While a trial balance is a helpful check, it does not perfectly capture whether all financial entries have been correct, because there are numerous types of errors that a trial balance would not catch. For example, a trial balance would not tell you if a wrong asset account has been debited during a certain transaction. Another concept that's often difficult to understand for those people being newly acquainted with accounting procedures is the concept of cash versus accrual-based accounting. Under the cash method of accounting, sales are recorded when cash is received, and expenses are recorded when cash is sent out. It's straightforward and intuitive. However, it has a problem. The problem is that it does not always accurately reflect the economic reality of a situation, so it can be inaccurate. Under the accrual method of accounting, revenue is recorded as soon as services are provided or goods are delivered, regardless of when cash is received. This is why we use accounts like accounts receivable. Similarly, under the accrual method of accounting, expenses are recognized as soon as the company receives goods or services, regardless of when it actually pays for them. Accounts payable is used to record these as yet unpaid obligations. The goal of the accrual method is to fix the major shortcoming and inaccuracy of the cash method, distortions of economic reality due to the frequent time lag between a service being performed and the service being paid for. At the end of each accounting period, all of the temporary accounts, such as revenue, expense, gain, and loss accounts, are zeroed out, with an income summary account being used for the other half of each of these journal entries. The purpose of zeroing out the balance in each of these accounts is to give them a fresh start for the next period. That is, the idea is to ensure that at any given time, a revenue account will show the amount of revenue that has been earned so far in that period without including amounts from prior periods. The same is true for expense accounts, gain accounts, and loss accounts. After all the temporary accounts have been zeroed out, the income summary account itself will have either a credit balance equal to the firm's net income for the period, or a debit balance equal to the firm's net loss. At that point, the income summary account itself is zeroed out, and either the debit or credit balance is transferred into the retained earnings account. Here are some other vocabulary items associated with GAAP concepts and assumptions that are important to understand. An asset's historical cost is often quite different from its current market value. However, due to its objective nature, historical cost is generally used when reporting the value of assets under GAAP. A transaction is said to be immaterial if an omission of the transaction would not result in a significant misstatement of the company's financial statements. Under GAAP, in order to simplify accounting, currency is generally assumed to have a stable value. This is known as the monetary unit assumption. Also, a business is considered to be an entirely separate entity from its owners. This concept is known as the entity concept or entity assumption. According to GAAP's matching principle, expenses must be reported in the same period as the revenues which they help to produce. Straight line depreciation is the simplest depreciation method. Using a straight line, an asset's cost is depreciated over its expected useful life, instead of recognizing the entire expense of an item that we expect to use for a long period of time immediately when it's purchased. With the straight line method, an equal amount of depreciation is recorded for each month of the asset's useful life. Accumulated depreciation is a contra-asset account that tracks how much depreciation has been recorded on each asset up to this point in time. An asset's net book value is equal to its original cost or historical cost less the amount of accumulated depreciation that has been recorded against the asset. When an asset is sold, if it is sold for more than its net book value, a gain is recorded. If it's sold for less than its net book value, a loss is recorded. Immaterial asset purchases tend to be expensed immediately rather than being depreciated. So these are for assets that are either very inexpensive or have a very short useful life. Intangible assets are real, identifiable assets that are not physical objects. In other words, you cannot touch and hold them in your hand. Common intangible assets include patents, copyrights, and trademarks. Amortization is the process which is very similar or analogous to depreciation, in which an intangible asset's cost is spread out over the asset's life. Generally, the intangible assets are amortized using the straight line method over the shorter of either the asset's expected useful life or its legal life. The perpetual method of inventory involves tracking each individual item of inventory on a minute-to-minute basis. It can be expensive to implement on the front end, but it improves and simplifies accounting. The other option, the periodic method of inventory, involves doing an inventory count, physically counting each piece of inventory at the end of each period, then mathematically calculating cost of goods sold. Now, FIFO, LIFO, and average cost are assumptions made when tracking the costs of goods sold. FIFO, or first in, first out, is the assumption that the oldest units of inventory are sold before the newer units. So when tracking costs, you would apply first the cost of the oldest unit and go on applying the cost of each oldest unit for each unit that you sell. In LIFO, you do the opposite. Last in, first out is the assumption that you will apply the cost of the newest unit of inventory that you purchased when calculating cost of goods sold, followed by the next newest unit, followed by the next newest unit, and so on and so forth. Average cost method is a formula for calculating cost of goods sold and ending inventory based upon the average cost per unit of inventory available for sale over a given time period. So it essentially gives you the average of the first in, first out, and last in, first out methods. So these are the basic accounting concepts that you should be familiar with. You should know these concepts well and be able to at least hold an intelligent conversation covering any of the concepts that we've talked about. As you can see, I didn't go into nearly the same amount of depth in explaining how to work with these concepts as an accountant would, though that information and that knowledge will be very important to those people who end up studying accounting as a concentration or go into accounting as a career. This basic overview is absolutely necessary for anyone who does really any type of work in their life. Any organization for whom you work, whether it be yourself, a business organization, a governmental unit, all of them deal with money. Money makes the world go round. If you don't understand these basic accounting principles, you will always be at a disadvantage when discussing financial items. It's often said that accounting is the language of business. And what that means is accounting is the language of money. If you don't speak that language, you can't have an intelligent conversation about money. You don't have to be the world's foremost expert in that language, but you do have to be conversant. If you understand all the principles that we talked about in this presentation, and you can carry that knowledge with you, you will be conversant in the language of money, which is the language of business.